Welcome back to the channel. My name is Rob, and today we're exploring a question many people have. Is it actually worthwhile paying a financial advisor to manage your money, or could you potentially manage just as well on your own? Let's break down the facts and try to bring some clarity to the discussion. Let's start with what the experts say. Government authorities, like the team behind Australia's Money Smart website, are clear. Financial planners can help you set and achieve goals, and generally feel more confident about your future. Major companies like MetLife also recommend seeking financial advice when you're facing major life changes, whether it's buying a home, getting married, starting a family, going through a divorce, or preparing for retirement. Each of these moments has the potential to transform your financial landscape, and the right guidance at the right time can make a significant difference. Financial services groups like the Solomons Group say employing a financial advisor is typically a wise investment when you weigh the potential benefits against the actual costs. Others, such as Grabowski Financial Planning, stress how critical financial stability is and suggest that an independent advisor is one of the most effective means to achieve it. Even not-for-profits, such as UniSuper, actively promote using financial planning for maximizing retirement outcomes, and for good reason. Retirement is something you only do once, so professional advice can be invaluable. When you browse any financial planning firm's site, you'll notice they often highlight huge amounts of client funds under management, hinting that becoming a client will automatically set you up for similar financial success. But it's important to look past this marketing and examine who actually uses these services and why. According to the 2024 Australian Financial Landscape Report, just over 10% of Australians use a financial advisor. Among those who do, the average investment balance is around $685,000. The biggest group, baby boomers, have around $474,000 on average. In contrast, the median superannuation balance of all Australians is only around $66,000. That's an enormous gap, highlighting how the financial advice industry is mostly geared toward wealthier clients. What does that mean in practice? If you only have $10,000 or $20,000 invested, you probably aren't looking for an advisor. For most, the value in advice really starts to add up once you've accumulated more substantial assets. Think $500,000 or more. The financial landscape becomes more complicated, and that's when a professional can help you identify opportunities or pitfalls you might not spot yourself. This brings us to costs. Advisor Ratings' 2024 report found the median service fee for financial advice in Australia is $3,960. That's significant for most people, especially since many benefits from advice might take years or even decades to show up. For lots of Australians, there comes a time when managing money becomes too complex to go it alone. Maybe that complexity comes at retirement, after receiving an inheritance, or when handling multiple investments and family expenses. A professional advisor is valuable for keeping you on track, seeing the big picture, and offering a second opinion before making major decisions. A well-qualified advisor doesn't just pick stocks. They're trained to help you define your life goals, develop plans to start a business, buy a home, manage debt, or set up retirement. They can review your income, set budgets, and suggest ways to deal with or minimize debt. For retirement planning, advisors can help optimize your investment strategy, reduce your taxes, and show you the best ways to create a reliable income, while making sure you get any government entitlements you're eligible for. They'll also draw attention to important areas such as estate planning and insurance, sometimes working alongside lawyers or insurance experts to make sure you're properly covered. But here's the challenge: the upfront cost. Most purchases give you instant feedback about value. With financial advice, you're often asked to pay thousands up front, then wait maybe years before the plan's benefits become clear. It's a leap of faith, a big ask compared to the immediate gratification of daily spending. People are understandably wary about handing over $3,000 or $4,000 for a retirement plan when it could take years to see any tangible results. It's very different from most purchases where you know straight away if you've made a good decision. That hesitation is valid. The Advisor Ratings survey reveals around 24% of Australians would like advice but aren't willing to pay current fees. Meanwhile, about 68% of those with an advisor are happy or can see clear benefits. On the other hand, almost a third don't feel they've gained enough value for the cost. Sometimes because strategies like debt reduction or tax optimization take years to show results. Context matters too. Studies show around 60% of Australians live from paycheck to paycheck, and 43% have little or no savings. This highlights another challenge. Lots of Australians could use support, but most can't afford it, certainly not at the industry's typical rates. If you're thinking of getting advice, do your homework first. As with any profession, find an advisor whose strengths match your needs. It starts with the scope of advice. Every advisor is trained to define what you want out of the relationship, so be specific about your priorities. If your main concern is superannuation, focus on that and avoid being steered into paying for add-ons you may not need. You'll save money and keep your priorities front and center. If you're new to financial advisors, meet with at least 3 to compare what they offer, their approach, and their fees. This should be a long-term relationship built on trust. You want someone who understands your goals and puts your interests first. Ask about fee structures up front. Many advisors set a fixed fee depending on your needs. This is the most transparent method. Avoid advisors who charge a percentage of your funds under management, as this can lead to higher costs that aren't always matched by better service. Only agree to ongoing advice and reviews if your situation really requires them. Many advisors offer regular reviews, sometimes annually, sometimes more frequently. However, unless your financial situation is particularly complex or fast-changing, quarterly or biannual reviews are often unnecessary and can drive up costs. Particularly with share portfolios in blue-chip stocks, frequent changes usually add fees but little value. Some advisors partner with stockbrokers, resulting in more reviews and recommended changes to generate commissions. Often, the benefit to the client is questionable, and the main advantage goes to the advisor or broker. Watch for advisors who want you to transfer your super to a wrap account for supposedly better flexibility or investments. In many cases, industry super funds achieve the same or even better returns with lower fees and more control for you. Don't rush into a more expensive setup without clear, factual reasons. Also, remember that many industry super funds provide free financial advice for things like investment choice, setting up a pension, or insurance questions. Always explore these no-cost services before paying for independent advice. Ultimately, using a financial advisor is an individual choice that depends on your specific needs, your financial situation, and your confidence to manage complexity yourself. While most clients report satisfaction, just as many people are held back by the upfront fees and the delayed benefits. Everyone's story is unique. If you've used a financial advisor or are considering it, let us know your experience in the comments below. If you found this discussion helpful, please like the video and subscribe for more honest, practical insights about managing your money. Thanks for watching.